We cut short last time to make adequate time for Barry Eggers, and it means we skipped the last topic, which is only a couple of slides, but it's really some important ideas if you're not familiar, if you haven't been through an exit. And I want to help on this because the exit is an important part of the evolution of your idea. Sometimes it means the point at which you can step away and you can start working on the next idea. Sometimes it means that you are even more involved in what's happening and are taking it through a major expansion that happens under new circumstances. So we can think about exits in two broad categories: good exits and not so good exits. Let's talk about the not so good exits. These are pretty obvious, and it comes out in really two forms typically. You don't get initial funding. That is, you've started it, you're working on it. You and maybe a small handful of other people are putting your free labor into this, but it doesn't reach takeoff speed. You don't get enough interest. You haven't come across a compelling enough idea to interest users. The team goes back to traditional jobs. You don't really have assets to sell. There's nothing there except some potentially very rich experiences. The other is that you've gotten funding, you've hired people, you're working actively, but you run out of runway. That the money doesn't last to get you to the kind of new accomplishments that will allow you to get additional financing, additional capital investment. And typically because you didn't meet key milestones in the business, like getting customers and getting customers to pay, sometimes it's really in a graceful kind of ramp down. Sometimes you hit the wall rather abruptly, and you don't have the opportunity to really find a graceful exit. And it's a kind of a fire sale where maybe you're helping to get some people hired. Maybe you have some IP assets. Maybe it's down to, I bought some servers and I'm trying to sell my servers. Sometimes you manage to not completely close, but go through a major restructuring where you say, we're going to continue on with a related idea with a much smaller team, maybe with new leadership, often in a significantly different business model or technology focus. So there is a successor, but it doesn't look much like what you were doing before you reached that point. And sometimes when you run out of funding, you have enough assets. Either there's key pieces of technology you've developed, there might be patents that you can sell, there may be some things that have value. And that money really typically goes back to the investors so that they have something to show. Those are good experiences, but it's not generally what people are looking for. People are looking for good exits. Now, as we discussed early on, acquisitions are far more common than going public. Going public is actually pretty rare, and it's great, and it's extremely exciting, and it is, I guess, viewed as a badge of success for any entrepreneur who gets their company public. But there are so many external factors, as well as a rare fraction of ideas that get to the scale in a reasonable period of time to create a business that becomes of interest to the average investor out there. Not a tech-specific investor, but somebody who's going to put this in their portfolio because it's going to generate gains in cash. So let's talk about corporate acquisition. Companies will buy startups because they see it as a key element in accelerating them in a strategic direction, that they really want the expertise, the product, the people, the reputation to be able to boost them in a new direction. A great example of that was Tensilica, where Cadence was deciding to get into the IP business in a much more strategic way, and acquiring Tensilica, which was a pretty well-known processor IP house, really gave them an anchor in the IP business. And so it was a strategic direction. Typically, companies will acquire those startups which fit into their channel, that fit into how they go to market. So, for example, in the case of Cadence and Tensilica, they saw Tensilica, which sold IP and tools, as a very close fit to their main business, which was selling tools. Our customers were largely the designers of chips. Cadence's customers were largely the designers of chips. Seems like a pretty good fit. Now, in the nuance, there were differences in terms of who within the company Tensilica tended to sell to versus Cadence. But from 40,000 feet, it was a good channel fit. When a big corporation looks at acquiring, they're going to be completely consumed by the question of how do they retain talent? And it's almost always the talent which is central to the acquisition. It's not the only thing. They want the product, they want the brand, but the talent is usually central, and therefore figuring out how to retain that talent, both in terms of making sure there are good jobs and in creating financial incentives, typically in the form of continued stock vesting or the replacement of stock vesting with new earnout bonuses or restricted stock units or whatever, but to create incentives that hold on to the team, particularly whoever is designated as key talent. It's not always reflective of the incentives which the startup put in front of people, but it is a key conversation that takes place of who do we want to hold on to and what is the amount of financial incentives that we need to create. It's not a fast process. There's a getting to know you process. There's a discussion about the possibility. Sometimes it comes from a place of, well, we want to get more involved with you, and we don't know yet whether we want a big license to your technology or we want to acquire you. It could come from an unsolicited approach. That is, they just call out of the blue. That's what happened, for example, with Babel Labs. We were not looking to be acquired at the time that we got approached by a couple of big players, including Cisco. But sometimes you turn on an active M&A process. You explicitly say, I am open to the idea of being acquired. Now, sometimes it comes from the right-hand column. You fear that you're running out of funding. It's not a great place to start an M&A process, but it's better than first hitting the wall and then sitting around with no income looking at one another. Sometimes it comes from the fact that you get an inquiry from one and you decide that you want to create a much more active bidding process going on. It's not fast. It can take typically 6 to 9 months from the point of initial approach, maybe halfway through that or 3 months into it, you agree on the terms. And then if the company's moving fast, a startup can be acquired in a 3 or 4 month process. There's a fair amount of due diligence. There's a fair amount of legal work to be done. But big companies know how to do that very well. Going public, of course, is exciting. We went public at MIPS. I was not centrally involved in the mechanics of it, but as I observed dozens of public offerings, it's clear that the scale the company needs is getting bigger and bigger over time, just as the valuation of the average public company gets bigger and bigger over time. You have to be valued at a level that makes it visible and interesting for the average investor. And so it's hard to go public at a valuation of a few $100 million. Just nobody's interested in companies that small. It also depends a lot on the state of the market. The market goes through cycles, and sometimes there's very little interest in IPOs, and in some cases there is. And when the window is open, it doesn't matter too much what exactly you're doing. If you're at a certain scale and a certain growth rate, you may be a very attractive candidate for an IPO. And if the window is closed, then it probably doesn't matter how fast growing, how exciting you are. It just isn't going to happen. There is lots of new infrastructure that has to come into place before you go public, for several quarters before, in terms of installing the financial compliance, the investor relations. There is a whole different kind of CFO and sometimes a different kind of CEO that is the right head. I would say that it's probably more of a change for the CFO than it is for the CEO, because the CEO is somebody who represents the exciting, tech-driven, visionary, and what makes a great vision-driven leader as a private company, especially a bigger private company, can also be successful as a public company leader. But there are very strict rules and very strict roles that a CFO plays. One thing that you have to understand is that public companies are measured by quarter-to-quarter growth and predictability. And if you don't have predictability, you are not going to be a good public company, because people won't know that they can invest for the long term, because they don't know what you're doing next quarter. So public companies have to be able to provide a forecast of their earnings. And if you're not within a few percent of your forecast, you're going to be punished. Yes, it's okay to outdo your forecast consistently. That's good. But if you have any shortfall, that gets punished severely. And sometimes it takes a long time. You miss one quarter and you may be in the doghouse for several years. So that means the structure of your business, the way in which you think about revenue generation, has to have matured significantly. I think as we think about the end of a company, and this is important sometimes on failures, but it's really important on acquisitions, is to understand the exact mechanics of how the investors get paid. They go through a waterfall analysis, and it works like this. You have some acquisition price. Let's suppose it's $100 million that the acquirer is paying. And you have to decide, well, who gets the $100 million? And you go through this waterfall analysis where the newest investors, those who have the most senior rights. So in these examples I'm showing here, we have Series A, so we have Series B, Series A, Series Seed, and common shareholders as the investors. So we have 4 constituencies that you see here. And really, it works by Series B looks at their rights. They have the right to either take out the money they invested or to convert their shares to common and to share in whatever the remaining pool is after all the other preferred investors have taken their cash back out. So first you have the Series B, And then Series A gets to make the decision about the money left over. And then Series C gets to make the decision about what to do with the money left over. And then common, which may be the original shareholders, mostly employees, and anyone who converted to common does that. So in this particular case, this is for a $100 million acquisition. So the B series say, okay, I put in $40 million, so I could get $40 million back out, or I could convert to common. And they understand that if they convert to common, then probably everyone below them will also convert to common. So they know that they will have a 25% share, because that was, according to the valuation originally done, they own 25% of the company with their $40 million. And so they make a decision to convert or not to convert. In this case, it makes logical sense for them to not convert. So they take $25 million out, or take their $40 million back out. That leaves $60 million. Now Series A gets to make their decision. They put in $20 million. They could take the $20 million, or they could take their share, which is now 25% of what remains, because the 25% of Series B is already taken care of. The economics work such that they would choose not to convert. They take their $20 million. So now there's $40 million left. And Series C looks at it and it says, well, we could take our $5 million out, or we could take our share of the remaining pool, which is 14%. They say, I will convert, because that 14% is now worth $5.7 million instead of the $5 million if they did not convert. And so they become part of the pool, and therefore together the seed and the common get to share the remaining, in this case, $40 million. And so you can see, how much the people put in. $40 million for B, they got $40 million out. Series A put in $20 million, they got $20 million back out. Series C put in $5 million and got $5.7 million out. So they made a little bit. And Common had the remainder, had $34 million that was split among Common. In this particular case, I've assumed that the CEO at that point had 11%. That's not a magic number. There's no reason why to think that would always be the case. That's a fairly rich number for a CEO to have at the point of gone through seed A and B. So they would get $7.6 million out of this acquisition. There may be an earnout for them, so they may not get $7.6 million up front. They may get it over 3 or 4 years. But that's the mechanism. And you can look at different acquisition prices, and you can see what the behavior of different series would be. So if the acquisition were for $300 million, it becomes clear even to Series B that they should convert. And so they take not $75 million, but they participate in the pool, and so on down the line. So for very small acquisition prices, especially in acquisitions which are less than the total amount invested, each preferred series will take as much as they can get. So Series B was kept whole. They didn't make any money on the deal, but they didn't lose any, just the value of the money over time. So they got $40 million in, $40 million out. Series A got what was left, $20 million in, $10 million out. They got half of what they wanted, and nobody else got any money from the acquisition. Now, if it's a low ball acquisition, there may be retention incentives for the employees, Common, and sometimes the CEO, depending on whether on what their skill set is. So they may still come out in good shape, but seed doesn't do very well. At $100 million, you saw that the later preferred investors were kept whole, but they made no profit. Seed made a little bit of profit, and common shareholders did okay. And in the last case, everybody made money. And in fact, the earliest investors made the largest returns. Seed, for example, made 450% of what they put in. So you get a feeling for what the incentives may be for different series, and it gives you an understanding of why they want to have as large a percentage for as small an investment as possible, because it's part of the economics. And they have to consider this range of outcomes. So it's worthwhile to understand this, even in the early stages, so that you have a visceral understanding of what different investors may be looking for. So we talked briefly about takeaways, but I think it's important to understand how the mechanics work, so you understand how the incentives vary across different kinds of groups. You avoid much of that thinking by doing a safe in the early round. You're essentially deferring all the hard questions, though the negotiation over discount and cap may be an important part of that. So that wraps up the portion on venture capital. We can keep coming back around to it because everything that we do has implications on investment, and investment has implications on all these other topics. But are there any quick questions that I can address here?
A very quick one, Chris. For these cases where it's not a good acquisition, it just goes out, but let's say Series B took his own money. There are some cases I heard there is like, in some scenarios, there is like 1 point something X. They first get 1 point something X before anybody gets. What is that?
Yes. Those are various mechanisms, typically in the form of participating preferred. There are two mechanisms, complex mechanisms that sometimes get injected into deals by savvy investors. Participating preferred is sort of this idea that the class of stock, in order to incentivize them, they get to, in a sense, double dip, that they get a guarantee of some return on their investment. They get more than 1x, so that they get some acceleration, and under certain conditions, they get more money out. Or there are mechanisms by which they get their money out and they get some converted share rights so that they can participate in the pool if there's more left at the bottom. So investors are very clever people, and they are in it to make money, and they sometimes will twist arms gently in order to get those additional mechanisms as part of their return. So you may need to be aware of them. In my view, they've become less common than they used to be, but they still happen all the time. The other mechanism that you may need to be aware of is anti-dilution mechanisms, which are essentially mechanisms that come into place if an investor pays a pretty high price in a round, and then a subsequent round is at a lower price. Suppose we had Series A that was valued here at say pre-money valuation 25%, like $80 million valuation or something. No, that's $60 million valuation. They may say, well, if you do a subsequent round at less than $60 million, you got to keep me whole. You got to give me more shares so that the price that I paid is retroactively now assumed to be a lower price. And there are various formulas you can use for complete anti-dilution protection, or for partial anti-dilution protection. So sometimes you find that in the detailed terms of a deal. And there are a wide variety of formulas, some of which are really pretty benign and have small financial effects, and some are quite major. Now, if you have, I guess it's called full ratchet anti-dilution, it means that you essentially not only giving up a bunch of shares to the new investor, you're also giving a bunch of shares to existing investors. And so it reduces the portion for the common quite significantly in that case. So look for those things. There's usually some sort of mild anti-dilution protection, which doesn't really affect the economics very much, but sometimes they're more extreme, extortionate anti-dilution protection.